this concept. This is an example of a bank. Just bear with me for 2 minutes and we'll quickly wrap this example up. Basically, the bank has 4 types of investments and it breaks them into 3 different buckets. As the name suggests, the first column is held for trading. Their intention is to trade. Answer is a no-brainer. It is fair value through profit and loss. Right? You don't even get into anything else. Held for trading, FVTPL. Now these are available for sale. So basically they are saying, I will not trade in them. But if I get a good price, I will sell it. The last one is held to maturity, where the bank says basically, look boss, I will give this loan, invest this in this GSEC, till its maturity, I will keep it with me. No sale. This is more similar to the amortized cost business model, where basically you are telling, I will hold it to maturity. That's the logical assessment. Let's look at more facts about this situation. Fact number 1, out of these government securities classified as held to maturity, 16% of these securities were sold. In the previous year, that was 2%. In the year before, it was 28%. Now, this is where I will want to wear the auditor's hat and ask management, on what basis did you classify this as held to maturity? Because when you call something as amortized cost, you said I will hold those assets to maturity. But as an auditor, I am saying, look, year 1, 28%, year 2, 2%, year 3, 16%. It does not add up. It does not smell right. So as auditors, please question management when you see sales from an amortized cost book. Very relevant for an NBFC. If you see sales, please automatically start questioning why amortized cost, why not FVOCI? And it could be a big impact on the financial statements, capital adequacy, and some of the other things. So this was the small point I wanted to draw on this example. The other example is basically in some cases the law says you have to show to me that the assets that you hold are liquid. It's called a liquidity coverage ratio for banks and NBFCs. To do that, you have to sell. Now, the moment you say I have to sell to show liquidity, my accounting classification cannot be amortized cost. It has to be fair value through OCI. So, a couple of FS specific examples here, but these were the nuances that I wanted to bring out. I tried to do some fancy animation here. Here is a company which manufactures cars, and here is a customer. So the company sells the car and gets a trade receivable in the books. The company then goes to a bank and says, look, I am discounting this receivable from you. You give me cash today. Right? As a company, these receivables are held to collect business model. But I sold this to the bank on origination. Now, the terms that I have with the bank is I will buy this loan back from you and repay you your money. What do you think is the impact on the business model? Do you think this is a amortized cost business model, or do you think this is a FVOCI business model? So sell to bank and buy back before maturity. Okay, good. Mixed responses are always good. It means we are all thinking right. Now the answer is, it actually depends on what is the term of the arrangement with the bank. So it depends on with recourse or without recourse. So if, for example, you're going to tell the bank whether or not I get my money, I will pay you money. Right? Then from an accounting standpoint, all you have done is taken a secured loan from a bank. Now, because you have taken a secured loan from a bank, there is no question of a sale of a loan. Therefore, it is amortized cost. In this example, amortized cost, assuming it is with recourse. Otherwise, could have become FVOCI. So both the answers are correct depending on what facts and situations you are going to look at. Again, the idea here is just to be making you aware of how it will work. It's not necessary that in all cases there will be FVOCI or in all cases there will be AC. Okay, a very important term or a concept that we keep on